Our guest tonight says the stock market is, quote, pricey, and tells investors to prepare for a correction. She's Erin Gibbs, Chief Investment Strategist at S&P Capital IQ. Ms. Gibbs, welcome. Good to have you with us. We could potentially see a correction of 10%. That's what you say. Why do you say it, and what should I do to prepare for that?
So the issue we have right now is that stocks are really priced for perfection. Right now, the S&P 500 is trading at about 15.6 times forward earnings, which means that you're paying $15.60 for every dollar that a company is forecasted to earn this year. Now, since the financial crisis, normally you'd pay more like $14. If you're going back even further, 15 years, you'd pay around $16. So it's not that we're a bubble or that we're, way above the historical range, but we're at the top of that range.
So if this happens, what should I do, Erin? Should I get out of stocks? Should I lighten up on certain kinds of stocks? What?
No, we're not saying sell. Again, this is not I'm saying sell, but I'm saying use any corrections as opportunities to get in. Right now, it is extremely hard to find good values. Like I was just saying, we're sort of at the top of that historical range. Now, in good economies, you can go much more expensive, but use any pullbacks, any disappointing news as opportunities to get into more equities. We still expect another 10% for the year.
Right. I mean, this is certainly a headline-driven market. We saw last week all the worries about the Ukraine, big sell-offs. Today, relief rally because of new developments in the Ukraine. Now we've got the Fed. You heard Steve Leisman's report. What's the most important decision that could come out of the Fed this week from Janet Yellen that could impact the markets? And what do you think the market reaction will be?
For us, it's all about whether she's going to raise the rates or go further into the language saying she's not just looking at unemployment. That's the biggest action that could really affect the market this week. If she raises rates, which is not what Wall Street is expecting, you could see a much bigger correction. Ultimately, I feel she's not going to raise rates. We're not going to look at any raising rates up until at least the second half of the year, or even 2015. But we're really looking for indication of language that it's not on the table right now.
In the short term, Erin, what is the biggest risk to the U.S. market? Is it China? Is it the Ukraine and geopolitics? Is it the underlying growth or lack of growth in the U.S. economy and corporate profits?
For us, it's more about the U.S. economy. Right now, think of it as we're firing on all four cylinders, but we're driving a Chevy Chevette, not a Ferrari. We really want to see more of the fundamentals come through and see those corporations start earning what we expected at the beginning of the year.
Well, carry on with that, because earnings are coming out in the next few weeks. At the end of the day, when all the numbers are finally out for this first quarter of 2014, is it going to be positive numbers for the markets or negative?
So we've seen a lot of revisions downwards, and that's where I'm really concerned about potentially having a correction. Estimates have come down from looking for about 10% profit growth for this year to a little about 7.5% growth this year. So, a pretty big revision just in 2 months. Now, a lot of it has been warnings about the weather has really hurt our profits and our revenues for first quarter. But that only takes you so far. Also, a lot of corporations are saying they're going to make up for it in the second half of the year. So we really want to see our companies able to beat those expectations as they did in 2013. And are we still going to be able to meet those growth expectations?
Erin, nice to be with you this evening. Thanks for joining us.
Thank you.
Erin Gibbs is Equity Chief Investment Strategist at S&P Capital IQ.